Yes, let's do it. Jedi options for today. We're going to be talking about the boomerang strategy. We have had tackle 25, dirty sexy money, poor boys covered call. We've been compiling lists, doing research over the past week, more than the past week actually, past couple of weeks, and the dirty sexy money list. I've got that on the mind. This is a list of more volatile stocks. This is a list of stocks that have more juicy premiums and typically work quite well and offer really good ROI for things like naked puts and covered calls. And when it comes to naked puts and covered calls, when you combine those, we call it a boomerang. So I'm going to teach you a little bit about a boomerang strategy, do an example on an addition to the dirty sexy money list for 2022, Western Digital, WDC. We're going to build a trade on that with this boomerang strategy. To kick this off, though, I want to draw a little picture. I'm going to be writing the Trading Justice newsletter for January as well on the boomerang strategy. So consider this, giving you a taste of what's to come in that newsletter. The angle that I wanted to approach here, I hate teaching the same thing every month, day in, day out, the same analogies, the same kind of approach. I always like to come up with maybe different ways of explaining something. So here's what I am going to use to approach this boomerang. Get the black background here. Okay, so we all agree that the way to make money is you buy low and you sell high. Buy low, sell high. Yep. Okay. Got it. Buy something at $10, sell it at 15. Buy something at 10, sell it at 15. What I like about the boomerang strategy is it does this by default, right? It does this by default. Another way of explaining buy low, sell high is to say, I want more exposure at lower prices, more exposure at lower prices, P for prices. And then I want less exposure at higher prices. Because that effectively is what is going on when you're buying low and selling high, right? At higher prices. So say I've got a stock. I've got this stock and, maybe right now it's right here. And I know in general, I want more exposure down here, right? I want to buy low. And if it goes up a lot, I want to sell high, right? Well, what's interesting about the options market and strategies like a naked put, like a covered call, is they do this automatically. So the idea with a boomerang, step one to the boomerang strategy is you sell naked puts. And what a naked put does, generally we're using out of the money puts, What this does is it obligates me to buy stock at a lower price, okay? And so if you look at this from a delta perspective, we usually sell let's say maybe a 20 delta naked put. So think about that from an exposure perspective. If I have a stock right now, and let's say it's at this price and I sell a put, right? That's step one, right? Step one, I'm going to sell a put. And I'm selling an out of the money put and it has a 20 delta. It's not a lot of exposure. It essentially means I make $20 per dollar increase in the stock. So I start with like a 20 delta right here, okay? Triangle is the signal for delta. If the stock goes down, my put option that I sold, the delta is going to increase. So my exposure increases. I get more exposure at lower prices. So maybe the delta goes to 30 and the delta goes to 40 and the delta goes to 50. Potentially, if I get assigned on that put option, I got to buy 100 shares of stock, right? The delta gets to 100. So I started with a lower delta, less exposure. The stock drops. And that put option essentially could turn into stock and gets me long 100 deltas. I have effectively bought low. I've gotten more exposure at lower prices relative to where the stock was at the beginning. Now, why is that a good thing? Well, it's a good thing because if this is a stock that actually is a good company, it'll go back up in value. And you go look at any long-term chart of any good company or good stock, when was the smartest time to take more exposure? It's when that stock was down, when that stock was low. So some people get depressed or disappointed if they sell a put and then the stock goes down. But the reality is, if instead of focusing on that one action, I sold that one put that 1 month and the stock went down, if you broaden your perspective a little bit and you look at it as one of a sequence of events or one of a sequence of trades, say, oh, so that month I sold a put, the stock went down, I bought the stock, I planted a seed that has the potential to harvest later on when the stock recovers. So step one, I sell the put. Delta small. Let's say the stock goes down. By the way, if the stock doesn't go down, I'll just keep that money that I got paid when I sold the put. It may not turn into stock. But if it does turn into stock, it's at a lower price. I'm buying low. So in this hypothetical, let's say the stock does go down and my put goes in the money and I allow assignment. Now I'm long stock. So the short put, that turns into potentially long stock. So step one, sell the put. Hypothetically, I get assigned. And if I don't, you can keep selling puts till you get assigned. And just know that eventually when you do get assigned, it'll be at a lower price than where the stock was at the beginning of the trade. And then let's say I get assigned and I'm long 100 shares of stock. So now I've got this exposure. I bought low. Well, I want to sell high. I want to get less exposure if the stock goes up. How do I get less exposure as the stock goes up, or quote unquote sell high? Well, you could sell a covered call. Unlike a naked put, which obligates you to buy stock, presumably at a low price, a covered call obligates you to sell stock, presumably at a high price. Seems like a good thing to me. And so if I get long the stock down here at 100 deltas and I sell a covered call, so to sell the put, you get long stock through assignment, and then you're going to sell a call. You're going to sell a call option. Let's say you sell a 30 delta call. Well, here's what's interesting about this. Okay. I'm long the stock. I have 100 delta. I sell some kind of call option up here. My delta goes to maybe 70 because I got 100 delta on the stock, 30 delta on the call. Well, guess what happens? As the stock goes up, that call delta increases. And because it's a short call, it's actually a negative delta. So it shrinks your overall exposure. So you go from 70 delta to 60 delta to 50 delta to 40 delta. And you're getting less and less exposure. Is that a bad thing? Well, not necessarily, because you wanted to sell high. You wanted less exposure at higher prices. And if at expiration, the stock is up high enough where you hit your call strike, you'll sell the stock. You'll essentially cash in and harvest the seeds that were planted at lower prices via the naked put. And then you can rinse and repeat. Do the same thing again. You could go back to selling puts again. So you sell these out of the money puts. If the stock goes down, you get assigned. If it's a good company, it eventually goes back up. And through the sale of calls, you can reduce your exposure at higher prices. This back and forth is what we call the boomerang strategy. We are trying to strategically use naked puts and covered calls to systematically, dynamically get long at lower prices, buy at lower prices, sell at higher prices, more exposure low, less exposure high. So here's the example. Here's the example. That's the concept. Here's the example. You take Western Digital, right? Which this is going to be on our Dirty Sexy Money list. It's a great stock for things like naked puts and covered calls because it's cheaper. It's only $66. It's got decent volatility. So there's some juice in the out of the money calls and puts. And I like this gap up today. I like the gap up. I like the strength. I like that we just reversed from a downtrend to an uptrend. And suppose I now want to pull the trigger and engage in this boomerang strategy. And I say, all right, Western Digital, you're at a point now where I'm going to buy you at lower prices and I'm willing to sell you at higher prices. Let's do this. Let's do this. Well, I need to start out and I need to sell a put. The stock's at 66. I'm going to sell an out of the money put to obligate myself to buy it at lower prices. I'm going to sell the 60 strike. So I'm going to go to January, only 23 days out. I'm going to sell this 60 strike put. It's a 15 delta. And I'm going to get, let's just make the math easy. Let's say I get 55 bucks. If you're curious, the collateral is only about $700. So your ROI is 7-8%. Okay. But more importantly, I'm obligating myself to buy this thing down at 60. So let's say it goes down to 60. Am I mad? Well, look, no, you didn't make the 55 bucks, but you get to pick up the stock 10% lower than where it was when you started the trade. That's buying low. And then presumably you go sell a put. You sell maybe a 65 put for February. And then if by February the stock goes back up to 65, you unload the stock, you sell at 65, what you bought at 60, and then you rinse and repeat again and again and again. I could probably go through 300 hypotheticals, but I like this concept. And if you can really embrace the magic behind this idea and look beyond what one trade did or what two trades did and look at how it works over time, I like this as a substitute to just buying 100 shares of stock. I like it because it keeps you engaged. It takes advantage of the overpricing of options. And I just think it's a really cool way of using options to enhance stock ownership.